We now focus on a firm's capital budgeting decisions. The objective is to increase the firm's current market value. The decision depends on the valuation of each project under consideration. Consider a project with cash flow from now to year T. Let CF0 be the initial cash flow, and CF1 to CFT be its expected future cash flows. Let the discount rate be R1 to RT for the corresponding cash flows. The NPV of the project is then given by the following discounted cash flow formula. It is simply the sum of the present values of all the pieces in the cash flow. This gives the increase in the firm's current market value if the project is taken. With the NPV of each project available to the firm, we can easily write down the decision rule on investments or capital budgeting. For a single project, take it only if its NPV is positive. For multiple independent projects, take all those with positive NPVs. Here, independent means the projects are unrelated to each other. An example of independent projects is to develop condos in far-apart cities. For mutually exclusive projects, take the one with positive and the highest NPV. Here, mutually exclusive means we can only do one. An example of mutually exclusive projects is when to build the same condo. Right now, next year, or later. Now, all we need to do is to compute the project's NPV. This requires three inputs. First, its cash flow. More precisely, its expected cash flow. Second, the right discount rates for the cash flow. Third, strategic options embedded in the project beyond the basic cash flow forecasts. We will focus mainly on 1 here and return to 2 and 3 later in part 2 of the course. Before we get into the details of figuring out the cash flow of a project, several general points are worth mentioning. First, for valuation purposes, we need to use actual cash flows, not accounting earnings. Although we often rely on accounting information to learn about a project's cash flow, we have to do so carefully. Earnings reported in accounting statements follow certain accounting rules, which may not adhere to the actual timing of the cash flow. As we already know, timing is a key element in valuation and needs to be captured accurately. We will see examples on this point soon. Second, use after-tax cash flows. We have already made this point when we first discussed the present value calculation. Shareholders or investors only care about the cash flow they actually receive after taxes. In the corporate finance context, firms do have to pay corporate taxes. Third, it is important that we only include cash flows attributable to the project. This will then give us the net gain from the project in firm value. This leads to various implications when computing a project's cash flows. Here, we list a few. 1. Use incremental cash flows. There's no need to include unrelated cash flows since we only care about the net value added by the project. 2. Ignore sunk costs. These are cash flows associated with previous decisions, not the current decision, which is about current and future cash flows. Let the bygones be bygones, as people say. Third, include investments in working capital. Fourth, include opportunity cost of using existing facility, losing existing sales, and so on. We can go on, but instead of talking about these points in abstract, we will illustrate them through a set of examples. Before doing so, we want to give a formal definition of a project's cash flow, which is given by the equation on the slide. The net cash flow equals cash inflow minus cash outflow. The project's cash inflow is simply its operating revenue. The outflow, however, consists of three pieces. First, operating expenses without depreciation. Second, taxes. And last, capital expenditures. This is summarized in the second equation. We can also rewrite a project's cash flow in a slightly different way. First, we define the project's operating profit as its operating revenue net of operating expenses without depreciation again. Next, we consider taxes. Let the project's effective tax rate be tau. Then the project's income tax will be the tax rate tau times the operating profit, then minus the tax rate times the depreciation. This second term comes from the tax credit the firm can claim from its capital investments. Here we note that accounting depreciation itself is not a cash flow, but it does affect the project's after-tax cash flow because it can be used to reduce the firm's tax bill. Putting things together, we have the following. The net cash flow of the project equals 1 minus tau times the operating profit, which is the after-tax profit, minus capital expenditure, plus the tax credit from depreciation. What we will do next is to go over a series of examples to demonstrate how to compute a project's cash flow from its financial data. Naturally, these examples are simplified compared to real projects, but they do provide useful illustrations on how to come up with cash flow estimates in various situations. Our first example is about the distinction between accounting earnings and actual cash flows. The project we're considering is as follows. It requires a purchase of a machine for $1 million with a life of 10 years. The machine will generate an annual revenue of $300,000 at an operating expense of $100,000. The machine can be depreciated over its lifespan using straight-line depreciation. The corporate tax rate is 40%. The financial information on the project is summarized in the table. The first column gives the year. The second column gives the project's pre-tax accounting earnings. Starting from year 1, it is revenue minus expense minus depreciation, which equals 300, which is revenue, minus 100, which is expense, minus 100, which is the depreciation. And that gives $100,000 of pre-tax earnings. The third column gives the after-tax earnings, starting from year 1, that is 1 minus the tax rate times the earnings, which is $60,000. However, we should know that it would be incorrect to simply discount the after-tax earnings at the cost of capital to get the NPV. The reason is that the accounting earnings did not accurately reflect the timing of the project's cash flow. For example, the initial expenditure, or sometimes called CapEx, of $1 million on the machine is not recorded as a cash flow in year 0. Instead, it shows up in the form of depreciation as part of the expense over the next 10 years. For valuation purposes, we cannot arbitrarily shift cash flows over time without proper discounting. In order to value the cash flows, we have to capture the amount and timing correctly. The actual cash flow from the project is given in column 4 in the table. It's computed as follows. In year 0, the cash flow is minus 1 million, the capex amount paid at that time. In year 1, the after-tax cash flow equals the after-tax profit plus the tax credit from depreciation. The first part equals 1 minus 0.4, the tax rate, times the operating profit, which is 300 minus 100, revenue minus expense, or $200,000. This gives an after-tax profit of 120K. The second part equals 0.4, the tax rate, times the annual depreciation of $100,000, which gives 40K. The sum of the two gives the total after-tax cash flow of $160,000. We have the same after-tax cash flow for the remaining years. It is obvious that the actual after-tax cash flow is quite different from the after-tax accounting earnings. This could be substantial. In fact, no matter what discount rate we use, the discounted value for all accounting earnings will always be positive. This is because accounting earnings are positive for all years, 60,000 every year. But if we use actual cash flows, the answer is different. For high enough of a cost of capital, the NPV of the project becomes negative. For example, you could try a discount rate of 10%. This example shows that accounting earnings are not the same as actual cash flows. However, if used properly, we can figure out the cash flow from the accounting information. Our next example focuses on taxes. The project's cash flow are given in the table, which are in $1,000. Assume its tax rate is 50%. The project spans from year 0, which is now, to year 5, as shown in row 1. It requires an initial investment of 500, shown in row 2. The operating profit given in the third row is 0 in year 1, 100 in year 2, 300 in year 3, etc. That's given in row 3. Let's assume that the initial capital investment of 500 can be depreciated linearly over the 5 years to 0 at the end. This then gives a depreciation of 100 from year 1 to year 5 in the fourth row. Know that depreciation does not represent the actual cash flow, but they can be used to reduce taxes. Row 5 gives the accounting income, which is the difference between operating profit and depreciation. We have minus 100 in year 1, 0 in year 2, 200 in year 3, and so on. As seen from the previous example, this is not the actual income because depreciation is not itself a cash flow. Row 6 gives the tax, which is the tax rate times the operating cash flow minus the tax rate times depreciation, the tax credit. This also equals the tax rate times the accounting income. We then have minus 50 in year 1, 0 in year 2, 100 in year 3, etc. The after-tax cash flow from the project, given in row 7, equals operating cash flow minus capital expenditure minus the tax. We then have 500 minus for year 0, 50 for year 1, 100 for year 2, and so on. There is one caveat here, however. In year 1, the operating cash flow is 0, and we have a tax bill of minus 50, which means a tax credit of 50. We won't be able to get the tax authority to wire us this amount. However, if the firm has other incomes it needs to pay taxes on, this tax credit can be used to reduce the tax bill on these income. $1 saved is $1 earned. If we can fully utilize this tax credit to save taxes, it is then equivalent to generating a $50,000 cash flow. This is what we assume here for simplicity. If this tax credit cannot be fully utilized in year one, we can then carry it forward to reduce taxes in the following years when there is income. All we have to do then is to properly discount the corresponding tax benefits. If the cost of capital for this project is 10%, we can then discount its cash flow after tax. The NPV we got is $39,000 roughly, and that's positive. This example shows how we need to treat taxes carefully in coming up with a project's cash flows. A project's cash flows can arise in different accounting forms. One of them is change in inventory. Let's consider a simple example. Suppose that you are running a chain of shoe stores. The financials are as follows. This quarter, you buy 1 million pairs of shoes at a price of $30 each. You expect to sell all of them in the next 2 quarters, $500,000 per quarter at a price of $60. The effective tax rate is 40%. What are the cash flows for this project? The financial data are summarized in the table. The first column is time in quarters. The second column gives the after-tax accounting profit. In quarter 0, it's 0. In quarter 1, the accounting profit is sales, which is 0.5 million, times profit margin, which is 60 minus 30, the sale price minus cost for each pair of shoes, then times 1 minus the tax rate. This gives an after-tax accounting profit of $9 million per quarter. But this is not the actual after-tax cash flow. In particular, the cost of shoes are paid in quarter 0 in the form of inventory, not in quarter 1 and 2. There are different ways to deal with this issue. One way is to directly go after the project's cash flow, which is given in the last column in the table. In particular, in quarter 0, we paid a total of $30 million for an inventory of 1 million pairs of shoes at $30 a pair. This is a cash flow of minus $30 million. In quarter 1, the revenue is 0.5 million pairs of shoes sold times the sales price of 60. That gives us $30 million. The tax bill is operating profit, which is 0.5 million times 60 minus 30, times the tax rate of 40%, which gives $6 million. Net of the two items gives an after-tax cash flow of $24 million. It's repeated in quarter 2. Another way is to look also at the inventory, which is given in column 3 in the table. Since inventory carries a price, its change implies a cash flow. In particular, a change in inventory implies an opposite cash flow of the same amount. Therefore, for quarter 0, inventory increases by $30 million. It implies a cash flow of minus $30 million, the amount of cash paid for that inventory. For quarter 1 and 2, inventory decreases by $15 million, respectively. It then implies a cash flow of plus $15 million, the amount recouped from selling the inventory. If we add these implied cash flows to the after-tax accounting profit, the cash flow will be 0 minus $30 million. That equals minus $30 million in quarter 0, 9 plus 15, which equals $24 million in quarter 1 and quarter 2. This is the same as what we have obtained previously in the last column. From this, we see that with changing inventory, a project's cash flow can also be computed as its after-tax accounting profit minus the change in inventory, which is given in the equation at the bottom of the slide. In general, there are timing differences between the accounting measure of earnings or profit, which is given by sales minus cost of goods sold, and the actual cash flows. This is specifically reflected in changes in working capital, which includes several parts. A simple definition of working capital is as follows. It equals inventory plus accounts receivable minus accounts payable. As we have seen from the previous example, changes in working capital, such as inventory, imply actual cash flows. Let's consider this in more detail. First, inventory. In computing earnings and profits, the cost of goods sold includes the cost of items sold in that period. The actual cost of these items may occur in different periods. When inventory is rising, the cost of goods sold understates the cash outflows. When inventory is falling, the cost of goods sold overstates the cash outflows. The second item is accounts receivable. Accounting sales may include sales that have not been paid for, which goes into accounts receivable. Therefore, accounting sales understate cash inflows if the firm is receiving payments from past sales. This corresponds to decreases in accounts receivable. The third item in working capital is accounts payable. Conceptually, this is just the reverse of accounts receivable. Therefore, with changing working capital, the after-tax cash flow of a project needs to include an additional term, which is minus the change in working capital, as shown in the equation on the slide. And last, we will consider a capital budgeting example that is slightly richer than the previous examples. MSW Inc. is a small manufacturing company selling widgets. It is now considering the launch of the next generation of widgets, turbo widgets, or TW for short. The data on TW is as follows. TW was developed over the last 3 years at an R&D cost of $1 million. Producing TW requires a new machine, which costs $2 million. The new machine lasts 15 years with a salvage value of $50,000 at the end. The new machine can be depreciated linearly to zero over 10 years. TW need to be painted. This can be done using the excess capacity of existing painting machines, which cost $30,000 to run independent of how much it's used. Operating cost is $40,000 per year. TW sales are expected to be $400,000 per year, but cannibalization will reduce existing sales of regular widgets to drop by $20,000. Working capital is $250,000, which can be recovered at the end of the project. MSW's tax rate is 34%, and its cost of capital is 10%. The question we want to answer is, should TW be launched now? Let's go down the list to identify each piece of the cash flow for this project. It's incremental cash flow. The R&D expense is sunk cost. It should not be included, of course. CapEx of $2 million for the machine is a cash outflow in year 0. Of course, that should be included. Depreciation of $2 million over 10 years, that is $0.2 million for each year from year 1 to 10, that's for tax purposes. Salvage value of the machine of $50,000 in year 15 is an income, but fully taxable. This is because the book value of the machine already hits 0 in year 10. The project should not be charged for painting. the painting machine is running anyway at no additional cost. Operating costs and sales should be included, of course. However, loss of existing sales should be charged to the project against its sales. Working capital is also an initial investment, but recovered in year 15. Adding up the different pieces, we then have the cash flow of Turbo Widgets from year 0 to 15 in $1,000. In year 0, the cash flow is minus $2,000 capex plus $250 the working capital. That gives us minus $2,250,000. In year 1 to 10, the cash flow is after-tax profit, which is $400, it's the sales, minus $40, that's the expenses, minus $20. That's actually the cannibalization of existing sales. And then times 1 minus 0.34, that's the tax rate, plus the tax credit from depreciation, which is 200 times 0.34. The sum is $292,400. From year 11 to 14, there's no more depreciation, no more tax credit. The cash flow is just the after-tax profit, which is $224,400. In year 15, the cash flow has 3 pieces. The first piece is the after-tax profit, which is $224,400. The second piece is the after-tax salvage value of the machine, which is 50 times 1 minus 0.34, because we have paid taxes on it. The third piece is the working capital recovered. Adding them up gives a total of $507,400. At the cost of capital of 10%, the NPV of Turbo Widgets is minus $57,600, which is negative. Therefore, we should not launch it now. This example merely illustrates some issues we need to pay attention to in forming cash flow forecasts for a project, given its financials. Given a project's cash flow forecasts, all we need are the corresponding discount rates to compute the NPV. For the discount rates, we have learned the following. First, a project's discount rate, which is also called the required rate of return or the cost of capital, is the expected rate of return demanded by investors in the market for the project and for similar traded assets. Second, discount rate depends on the timing and risk of the cash flow. Thus, in general, it can be different for different pieces of a cash flow. Third, discount rate is in general different for different projects. Fourth, it is in general incorrect to use a company-wide cost of capital to discount cash flows of all projects. The cost of capital is project-specific and can vary substantially across different projects with different risks. What is the discount rate of a project? In the simple case, a single discount rate can be used for all cash flows of a project. This is mostly an approximation. In the general case, we need to use different discount rates for different cash flows, depending on their timing and risk. For example, even with safe cash flows, $1 in different years should be discounted at different interest rates if the term structure of interest rates is not flat, as we have learned from the fixed income market. We will return to the determination of discount rates later by applying the risk analysis and asset pricing tools we have been developing. But in this lecture, we will use a single discount rate mainly for simplicity. Often, we face multiple projects. As a firm, there are almost unlimited number of projects it can take. The key is to find the good ones, namely those with positive NPVs. For mutually independent projects, we can simply apply the NPV rule to each project. This implies that we would take up all the projects with positive NPVs. For projects dependent of each other, in particular mutually exclusive, we then have to compare their NPVs and pick the highest one, assuming it is positive. To illustrate this point, let's consider a simple example. You have just developed a new product. The decision now is when to bring it to the market, say in year 1, 2, 3, or 4. If we view each choice as a project itself, then the timing decision is between a set of mutually exclusive projects. We can launch the project only once. Several factors can influence the cash flow forecasts and the timing decision. For example, the demand for the product may increase over time. In addition, launching it early will also cause your competitors to catch up sooner. Let's assume the opportunity cost of capital for the project is 10%. We can compute the NPV for each launching date at the time of launch. We denote this by FPV, the project's future present value. The numbers are reported in the table. If launched in year 1, the NPV then is $100 million. If instead launched in year 2, 3, and 4, the FPV will be $120, $138, and $149 million, respectively, as shown by row 2 to 5 in the table. Clearly, by waiting, the FPV increases. But how long should we wait? There are two ways to resolve this. First, we can consider the rate of return by waiting. If we wait until year 2, the value appreciates by 20%, as shown in the third column of the table. If we wait longer, the return will be 15% and 8%, respectively. Are these good returns? Well, keep in mind that by waiting, we are holding the project as an asset with its risks. We also know the cost of capital is 10%, which is the return on similar assets in the market. Therefore, waiting is desirable only if it yields a return higher than the cost of capital. Column 3 shows that the return from waiting is higher than 10% until year 3, while waiting from year 3 to year 4 is only 8% lower than the cost of capital. This gives us the optimal time to launch the project, which is year 3. Second, we can also compare by discounting the FPV of different options back to year 0 at the cost of capital of 10%. That is, to compare the NPV now. Column 4 gives the numbers. Clearly, launching in year 3 gives the highest NPV today. Other than being mutually exclusive, projects can be dependent in other ways, such as sequential. That is, project B is contingent on project A. For example, selling advertisement through a social network is contingent on building the network first. Such a dependence is what we called strategic options earlier. We will return to this topic later in part 2, after developing a better understanding on options and effective tools to value them. Although we have been advocating the NPV rule for capital budgeting decisions, in practice, other rules are also used. We can list some of the common ones: the payback period, internal rate of return, sometimes also called IRR, profitability index, sometimes also called PI, and so on. As often the case, for the correct answer, there's only one, while for the not so correct answers, there are many. We will show a more extended list of these alternative rules by the end of this lecture. Firms use these rules for various reasons. First, they were used historically, and habits die hard. Second, they may have worked in previous situations, often combined with common sense and other considerations. Third, under certain circumstances, they do give the same answer as NPV. But in general, they don't agree with NPV. Therefore, it is important to note that the NPV rule dominates these alternatives. Nonetheless, given their presence in practice, we will discuss some of these alternative rules, their validity, and limitations. The first rule we consider is based on the so-called payback period of a project. A project's payback period is defined as the minimum time, denoted by S, such that the sum of net cash flows from the project turns positive. In other words, it is the time taken for the sum of the project's subsequent payoffs to just cover the initial investment. This is formally given by the equation highlighted on the slide. The capital budgeting rule based on the payback period first specifies a threshold payback time, say T star. Then, for independent projects, accept all those with payback period not exceeding the threshold. For mutually exclusive projects, among the projects with payback periods not exceeding the threshold, except the one with the minimum payback period. Let's consider an example to illustrate this rule. Suppose that the payback threshold is 3 years, and we have two projects, 1 and 2. Their dollar cash flows are given in the table in $1,000. Their payback periods are 4 and 3 years, respectively, as given in the last column in the table. This is easily seen. Take project 1, for example. The initial investment is $100 in year 0. Positive payoff starts at $20 in year 1, then $40 in year 2, with the sum being $60, then $30 in year 3, with the sum being $90, and then $10 in year 4, with the sum being $100, which just equals the initial investment. Therefore, its payback period is 4 years. With the cutoff payback period being 3, the firm will reject project 1 and accept project 2. But looking at the two projects more carefully and what the payback period does, it has two obvious shortcomings. First, the rule ignores cash flows after the payback period. For example, project 1 has substantial cash flows in year 5 and 6, which are totally ignored in the decision. Second, the rule ignores discounting. Both of these omissions can lead to deviations from the optimal decision. To see this, let's assume that the proper discount rate is 10% for both projects. We can then compute their NPVs. In particular, project 1 has an NPV of roughly $39,000, while project 2 has an NPV of roughly minus $7,000. But by the payback rule, project 2 was accepted, not project 1. One can think of possible fixes to overcome the rule's shortcomings. For example, incorporating proper discounting, one can define the discounted payback period as the time it takes for the sum of the discounted cash flow first exceeds the initial investment. This is better than before, but still ignores the cash flows after the discounted payback period. The next rule we consider is based on the internal rate of return, or IRR. A project's IRR is defined as the number that gives a zero if used to discount all the project's cash flows. Mathematically, it is defined by the equation on the slide. Clearly, IRR, if it exists, is solely determined by a project's cash flow. We don't need any other information. The decision rule based on IRR is as follows. First, a threshold rate or a hurdle rate, IRR star, is set. Then, for independent projects, accept all the projects with IRR greater than the hurdle rate, IRR star. For mutually exclusive projects, among the projects with IRRs greater than the hurdle rate, except the one with the highest IRR. Let's consider an example to illustrate the use of IRR rule. Again, consider two projects, 1 and 2, with cash flows given in the table on the slide. These are the same two projects considered for the payback rule. We can find their IRRs through numerical solutions. As it turns out, Project 1 has an IRR of 21% and Project 2 has an IRR of 7%. At a hurdle rate of 10%, say, only Project 1 will be accepted. This is the same choice as from the NPV rule as we saw earlier. Although IRR is widely used in practice, there's no guarantee that it gives the right answer. The IRR rule leads to the same decision as the NPV rule when the following conditions are met. First, cash outflow occurs only at time zero, or more generally, cash flow changes sign only once. Second, only one project is under consideration. Using IRR to rank projects is problematic, as we'll see in a minute. Third, opportunity cost of capital is the same for all periods. From the definition of IRR, it is used to discount cash flows for all different periods. As we said before, in general, cash flow at different times should be discounted at different rates according to their timing and risk. Fourth, the hurdle rate is set to be the same as the cost of capital. Since IRR is determined solely by a project's cash flow, some people argue that it is easy to use because it requires no finance expertise, which is about discount rates. But this is not quite right. Even with IRR, the rule relies on the right hurdle rate. Given the popularity of IRR rule in practice, we want to point out some potential issues in its use. We start from the more technical ones and then move on to the more serious ones. First, given a project's cash flow, there may not exist an IRR. Sometimes there may be more than one IRR. We show this with two examples. The table on the top left of the slide gives the cash flow of a project. The figure on the top right plots the discounted value of the cash flow at an arbitrary discount rate R. An IRR is given by the point where the cash flow's discounted value curve crosses the x-axis. Clearly, in this case, the curve never reaches the x-axis, implying no solution for the IRR. The table on the bottom left gives another cash flow, and the figure on the right plots the cash flow's discounted value curve. Here, the curve crosses the x-axis at two places. One is between 0 and 0.05, and another between 0.1 and 0.15. Which one should we pick then in this case? No obvious answer. Obviously, in these two cases, the project's cash flow changes sign twice, violating one of the conditions needed for IRR to work. Next, we show that IRR cannot be used to rank projects when choosing between them. We show this with an example. The example describes two projects, 1 and 2. Their cash flows are given in the table on the slide, in row 2 and 3. Column 3 gives their IRRs, 100% and 80% respectively. Suppose the hurdle rate is 10%, the cost of capital for these projects. Then both projects pass the hurdle. If they are mutually independent, we will do both. However, if these two projects are mutually exclusive, we have to choose one between them. Clearly then, project 1 wins because it has a higher IRR. If we compute their NPVs at the cost of capital of 10%, which are given in the last column in the table, then project 2 should be taken because it has a higher NPV. What's going on here? Well, if we look at the two cash flows more carefully, we'll notice that project 2 is a bigger project with larger cash flows. Even though it has a smaller IRR, its larger scale leads to a larger NPV. Given that we want to maximize the total market value, project 2 clearly delivers more. What we learn is that IRR, being a rate itself, does not capture the scale of the project. Therefore, it will miss the scale factor when it's used to rank projects, which may well have different scales. The last rule we're going to consider is based on a project measure called Profitability Index, or PI. The PI of a project is defined as the ratio between the present value of its future cash flows by its initial investment. Formally, it's given by the equation on the slide. The decision rule based on PI is as follows. For independent projects, accept all with PI greater than 1. For mutually exclusive projects, among those with PI greater than 1, choose the one with the highest PI. However, PI suffers the same drawback as IRR in comparing projects with different scales. In fact, by normalizing the present value of future cash flows by the initial investment, PI is intended at removing the scale factor. Obviously, scale matters for value creation. More is better. The example on the slide further illustrates this point. For the sake of time, we will skip it here, but you are more than welcome to go over it yourself. To wrap up our discussion on the alternative rules in capital budgeting, we briefly present the results from a survey of CFOs from a broad set of companies. The figure on the slide shows the percentage of CFOs surveyed who use a particular capital budgeting rule. The y-axis lists the rules used, and the x-axis gives the percentage of CFOs always or mostly always use that rule. Here are a few observations from the data. First, there's a long list of rules being used. We live in a rich world. Second, NPV and IRR are on top of the list in terms of usage. It is indeed the case that IRR has been around longer than NPV. Payback is quite popular as well, despite its drawbacks. And PI is on the list too, but towards the bottom, despite its wider validity, except for comparing projects. Third, if we add up the percentage of all the rules on the list, it way exceeds 100%. This means that multiple rules are often used at the same time. There could be a range of possibilities for why this is the case. At one end, don't know which one to use and just throw a bunch at it. At the other end, use several rules to complement each other and to arrive at a more robust answer. Hopefully, the latter is more often the case. Before we finish our introductory discussion on capital budgeting, there are a few additional points we would like to make. The first point is on cash flow forecasts. The precision of these forecasts is less of a concern, except that it may reflect the risk of future cash flows. What is more important is to do our best to avoid any systematic biases in the forecasts. Leaving aside intended biases managers may have, there can be honest mistakes or missed factors. One example is the response of competitors. If a project is very profitable, such as a new product or a new business model, it is easy to think that the profit will continue for a while. But the fact is, a more profitable project will more likely attract imitators. They will cut into the project's future cash flows. Underestimating future competition can lead to overly optimistic cash flow forecasts. Next, in our analysis, we have said that a firm should take on all the independent projects with positive NPVs. This requires that the firm does not face any constraints in doing so. One possible constraint is the amount of capital available. With the well-functioning market, this should not be a problem. The firm can always raise capital if it has good projects also recognized by the market. In reality, however, there could be deviations. Since large public companies have easy access to the financial market, capital is rarely a constraint, except in unusual circumstances, such as severe information asymmetry or financial crisis. For small firms, the access to financial market can be costly. This may impose a soft constraint on capital, therefore the firm's ability to take on more projects. But the truth of the matter is that good projects are more scarce than capital. There are, however, situations in which capital constraint can be more real. One example is capital allocation within a firm. A division inside a firm does not have direct access to the financial market. Its capital is often provided by the firm's headquarters. At a given time, the division may only have a fixed amount of capital at its disposal. Such a situation is also called capital rationing. What do we do then with capital rationing? The answer is fairly straightforward. Let's think this over. Suppose that we have n independent projects. They all have positive NPVs. For each project I, let its initial investment be I subscript I. Its NPV be NPV subscript I, which is assumed to be positive. Let the total amount of capital available be capital I. What we should do is to choose the set of projects such that, first, the total investment is no greater than capital I, the total amount of capital allocated to us, and two, maximizes the total NPV. The last point we want to make is a more general one. Our analysis focuses on the computation of a project's NPV given its cash flow forecasts and the discount rates. We did not talk about where these projects come from. Presumably, they come from the business opportunities the firm explores, that is, the real side of the firm. What finance does is to evaluate them when they show up. If we find positive NPV for a project, it will be a bit too simplistic to just go ahead with the number. There are additional questions we should ask. For example, are our assumptions reasonable? How robust is our answer? But more importantly, we should think hard about where the project's value comes from. For example, is it from the firm's short-run competitive advantage? For example, at the right place and the right time? Or is it from long-term competitive advantage, such as patent, technology, brand, economy of scale, etc.? Or is it just noise, like a pure luck, such as finding a $100 bill on the sidewalk? It's a positive NPV project to pick it up, but you're probably not going to be spending a lot of time on the sidewalk hoping to find another $100 bill. Our analysis will be more complete and reliable if we know better about the source of value from a positive NPV project. Just having a positive number for NPV without knowing what is behind it is far from being sufficient.